How's it going? Welcome back, it's Jonathan. Now in this video, you've probably all been wondering, where is the low price in gold? Now a lot of people have come out and done their own forms of analysis, and I'm going to show you as a little bit of a follow-up from our anniversary method last time, what I was looking at to try and locate the low in gold. Now, when I go through this, I'm not going to be able to provide you all the research and analysis in this one video because I want to keep this video around, 5-10 minutes long. But I'm going to give you two methods I was using. One will involve the anniversary dates, and the second one is going to involve the square of 9. Now, if you don't know what the square of 9 is, I do use it as my price analysis method. And essentially, we're going to be using the static square of 9. Now, the static square of 9 uses the same number series using the square of 9 and plots these values in accordance with selected angles. Unlike the dynamic square of 9, this tool does not derive its calculation from a starting point on the chart, meaning it does not matter where you click on the chart, it will always be 1. That just means that it'll always start at the value of 1 and move the square of 9 out. So essentially, if I add more values on, so it'll always start at 1 and it'll always move the chart out, okay? So I can increase the rings and we're going to get more rings. And if we were to look at the price of gold, for example, the gold would be sort of in this 1800 range. And we'll be using the square of 9 to locate natural support and resistance levels based on this theory. So if I just head over now and take a look at this, there's two things that I look at. First of all, I put on all the square of 9 levels, so I'll activate them all. And then I'll deactivate the ones that haven't had much luck in the past. So what I would do here, if I was to show this to you, when I put on a level, what I'm looking for is, let me get rid of the dynamic square of 9 quickly, as I'm looking to see how a level has reacted in the past to ascertain if that level is going to provide some form of support and resistance in the future. And if we have a level on here that is never being hit or is never being activated, so to speak, I'll simply turn it off. So we can see, for example, if we were to keep on the 45-degree angle, I'd be looking for the market to show some form of support or resistance around this level, and especially to the upside. We want these 45-degree angles to be showing some support and resistance, and if we head down to the next one, to be showing some form of support and resistance in the past, to then keep it on. And of course, if we look at the 180-degree, which is this blue one here, if I was to just explain this simply, let's get the square of 9. Basically we have our 0 degree over here, and everything that is on this line here, for example, the number 1, the number 2, 11, 28, 53, 86, 127, and so forth, that is on the 0 degree angle. If we were to move around the circle and were to go around to the 180-degree angle, then all the numbers on this side will appear, such as 6, 19, 40, 69, and so on. Now in this instance, we're using a static square of 9, which is going to give us harmonic levels. For example, 1786, 1621, 1464, and so on. And that would essentially be saying that if we were to have a circle right now, then it would be targeting all the angles on this side here, because we have 0 degrees and we have 180 degrees on this side. That's pretty much all it means. So now what I want to be doing here, as I said, is I want to be finding what the active angles are. And then I can use those active angles into the future. Every market, every stock, every industry will have different active angles. And in some instances, I will only want to have maybe 2 or 3 active angles on the chart, and I would basically get rid of all the rest. And this is what I'll be doing, is I'll be eyeballing where these active angles are. So if I turn on and off the 240 angle, I can see that it hit down here. Let's go ahead and turn that off again. And then I'm going to turn it back on in this new area. And I want to see what's hitting on that 240 angle. And if we just have a look here, we can see this one here, this one here. So it is providing some form of support and resistance around this angle, okay? And that's natural support and resistance. So that is basically what I would do to find what the natural harmonics are in the market using the square of 9. It's very simple, and it's just a matter of eyeballing the market, keeping on the active angles and deleting the inactive ones. Now, when a market touches one angle, it'll usually move to the next. And if it breaks through one angle, it'll then move to the next active angle. Okay? It'll vibrate between those angles until it breaks it, and then it'll move to the next active angle. And this is basically what I was watching here for the gold market, especially last week and this week, was to see where, or at least which one of these active angles was going to activate on gold. Of course, if you were to use basic technical analysis, you would have just basically said, there's basically support level right here, and then you're going to move that out here, and you've basically got support. You know, all those become future where new lows will form. So you basically got this double bottom down here, and you're looking out into the future to say that the market's basically going to come down to this range. That is what you do if you're just using basic support and resistance. I prefer to use the squares because I think they're going to give me a clearer picture of where these angles are going to activate, okay? So now that we've got the angles that we're watching, we want to know time. And for the time method, I was basically using anniversary dates because I wanted to find out where this market was going to turn. So if I go to my time analysis and we're looking for time measure, what we were looking for is we were trying to pinpoint 360 degrees into the future, because basically we're using one solar calendar year into the future to try and find out where the market was going to bottom. And then I would put these on our anniversary dates and we'd try and find out where that market is going to bottom. And we'd have a few of these now, because now we will be moving out into the future. 360. And that is pretty much what I was doing. So I was waiting for a potential turn to occur around the 28th. I did say the 26th in the other video because I had a different chart up, but the low actually did come on the 28th. So what I actually did was I went long at the 315 degree angle, and was promptly stopped out underneath these lows. So that was a trade failure. Okay, so what happened next was basically move in to the next angle and the next time count. Let me get this chart fixed up. And basically on the 270 degree angle, went long again. And as we can see that today, the market is around 1850. Now, the negative news is that I had tight stop losses. So I was actually stopped out. I was actually stopped out last Friday as the news came out, and I didn't capture this run. But this is the thinking that I had when I went long on gold, was I was looking for those time and price. So I had two stop outs here. I didn't hit the price of gold. But if we get any now, this is a daily chart, so if we get now any intraday decline, I would then be looking to long gold again, especially on these levels here. And I would be looking to long gold into our next anniversary date. So then I'd be watching these dates here, specifically these dates here, for now, because they seem to be activated right now. The market is gyrating around these old lows, and this is basically what I'll be watching. So when you go out and you do this yourself, you'll be wanting to calculate, first of all, the square of 9, that's your price, support and resistance levels, and then you'll be wanting to find a method to be using to calculate when these turns are going to occur, and you'll be using time analysis for that. And the method I taught you is going to be using anniversary dates, and that's probably the most simplest for you to start on and to get an idea on how this works. Now, I don't recommend ever that you would go long or short a specific stock or index or anything like that. Especially if you're looking at buying gold, we only talk about buying physical gold, okay? Physical gold, physical silver, okay? Any asset that is regulated by any exchange or whatnot, we can't be trading that. We can't be recommending anything like that, okay? So if you're ever going to buy gold, especially on listening to anything that I've said, it's only ever to be physical gold. And then should you wish to sell physical gold, that would be your choice. Again, everything's coming down to your choice, and don't take anything I say as advice, okay? So that's basically what I was doing. Now, when it comes to the square of 9, like I keep saying, the market will move between these levels, and if it breaks one level, it generally shoots up for the next. If it breaks it, it generally shoots up to the next. This is going to be our most accurate and predominant forms of support and resistance levels. And a lot of people, when they show you their chart and they have a rectangle and they've drawn a rectangle on and they've highlighted support and resistance levels, most of the time, like 90% of the time, these are just old harmonics of the square of 9. What we're doing is we're getting directly to the square of 9 and we're finding out when these angles are activated so that we can actually know when we can trade them. And then we're putting on our charts these time elements, and then we have more confluence on when we can actually trade them, okay? So what we have here is we have an expected top in the market, which was on the October 4th. We went forward in time to October 4th, and we were saying we're getting now an anniversary date expiry. The market is possible to be turning around this area. Unfortunately for me, I have a trade in big money size, so I have my stops really tight. So I generally keep my stops under prior day's lows. If they get taken out, I just wear the loss, mainly because the lot size that I'm using is quite large, and the amount that I'm buying is quite large, and I try not to risk too much per trade. Okay. So where to from here? Well, if we're going to be looking specifically at gold, we might find some resistance at this 1849 square of 9 level, which it looks like it was sitting against. If it breaks that, then our most logical resistance level is going to be the next square of 9 level up here, which is the most recent one that has been activated to the upside. If I go ahead, I'm just going to put this down here. If I go ahead and activate some other levels, we get nothing around there, 360. We've got a 360 degree angle, which is at 1871. We're going to keep this red one on. We're going to see if it's provided any form of support and resistance in the past. We have one resistance level there. We've got some minor resistance here. We've got resistance in here. Okay, so we might keep this one on as a form of resistance level just for now, just to see if it provides a resistance level, basically at 1871. So that would be the most, that would be the closest one watching, and then the second one here would be probably the most probable one that we're watching if it's broken, okay? If the market does continue to fall, it'll then bounce off one of these levels here, and we'll just be looking for that to occur around our time counts. So that's pretty much it. That is basically my theory and my way of looking at the square of 9, and basically how I would be doing it myself. What I wanted to just remind you is, with the square of 9, especially on this 180 degree angle, we look at our numbers: 1464, 1621, 1786, 1786, 1621, 1464. We're basically grabbing the angles on the square of 9, putting them on our chart, and finding the most accurate levels for that one, okay? And just keep in mind that this is a static square of 9 method. This is not a dynamic square of 9, which goes into other Gann methods. This is the one that I've been using for the longest time, and the one that I've found the most success in, especially for your longer term trading, okay? If you're doing intraday trading, you need to have intraday methods, but definitely for the longer term methods, you'll be using the static square of 9, and you'll be grabbing these levels off your chart and basically, off the square of 9 and basically putting them on your chart. It's probably the most easiest way I can explain it to you, and just showing you examples right here. That's all I have. I'll talk to you real soon, okay?